Howdy, everybody. Welcome to the weekly wrap-up. It is Friday, November 18th, 2022. Hope everybody's having a good day out there. The sun has finally come out. It looks like it finally finished snowing here in Colorado. We got about maybe 2 inches. Not too bad. Hopefully most of it will melt off over the weekend and save me from having to do a lot of clearing myself. After I'm done with this, I got to go outside and at least clear off the cars and the front part of the driveway so it's not so slippery out there. Anyways, if it's your first time watching, please, hit the subscribe button. It's probably right around here somewhere. Give me hit the thumbs up, the heart, whatever the things are. I would greatly appreciate it, and share with some friends and family because, it's crazy times out there in the markets, and I'm sure someone could use some of my wealth of knowledge. Anyways, all right, well, let's go ahead and jump into the numbers for today. Things looked far better than the last couple days. Dow Jones, let me close that. Dow Jones was up 0.59%, closed at 33,745. The S&P 500 was up 0.54, closed at 39,67. NASDAQ was flat at up 0.01, closed at 11,146. Small caps are up 0.84. The VIX was down 3.38. It's currently sitting at 2311. Canada's markets are up 0.48. Brazil was down 0.82. Mexico up 0.44. In Germany, they were up 1.16. The UK was up 0.53. France was up 1.04. The Euro Stoxx was up 1.2. Netherlands up 0.59. Spain up 1.08. Italy up 1.38. Switzerland up 1.17. And Portugal up 0.48. So really good numbers across Europe. The lowest ones were the UK and Portugal. But most of them were up more than 1%, so pretty good there. Both Russian exchanges were in the red. The MOX was down 0.3. The RTSI was down 0.39. Headed over to the Asian markets overnight. Japan was down 0.11. Let's see here. Australia was up 0.23. New Zealand was up 0.67. In China, the Shanghai was down 0.58. The SESE component down 0.37. The China A50 down 0.22, DJ Shanghai down 0.6, the Hang Seng down 0.29, and the Taiwan weighted down 0.21. So overnights were not great, but nothing down too dramatically in Asia. And like I said, Europe did fantastic, and kind of pretty good here in the U.S. So, all right, well, let's take a peek at the major indexes and see how they performed for the week. All right, the Dow 30 looks like it's going to finish the week off about up or pretty much flat at up 0.16. The S&P 500 looks like it's going to finish the week down about 0.42. The NASDAQ, it's going to finish the week off about 1.25 down. The Dow Utilities looks like it was up 1.36, and the Dow Transports looks like they finished off about 1.8 in the down or in the red. So kind of a mixed week across the big indexes here domestically. Let's take a step back and look at the S&P 500. As we can see, starting at the beginning of the year, we've had a couple of these rallies. Both of them have kind of bounced off this resistance line. We've kind of fallen short here on the S&P 500 on this latest rally. So my guess is it's probably going to tip over the next couple of weeks and fall back in line. Now, looking at the Dow chart, it did go through the resistance point, but again, it looks like it's kind of tipping over. All of the other technical charts kind of show that. So we'll have to kind of wait and see what happens there. All right. Well, let's go ahead and go through this week's economic data and see how things turned out. I know we covered some of this yesterday or earlier in the week as the news broke, but let's go ahead and go through the numbers. Initial jobless claims came in at 222,000, below the 225,000 forecast, so pretty good there. Continuing jobless claims came in at 1.507 million. The forecast was 1.5 million, so just a smidge over forecast. But again, looking back at the historical numbers, it has been creeping up over the last couple of months from as low as about 1.3 million Now we're at about 1.5. So it looks like the continuing claims are, starting to creep up, but not certainly in any bad territory. The producer price index year over year came in at an 8. The forecast was 8.3, but it has been slipping. But we still did have increasing costs. I think it was up 0.4, if I remember correctly. You can go back and look at my earlier videos, and I'll have the exact numbers. Retail sales year over year came in at an 8.37. The previous month was 8.59, so it did slip a little bit from last month. Industrial production year over year came in at 3.28. Last month was 4.96, so a pretty big step back from the previous month's number. Again, not really surprising with the economy slowing down. U.S. housing starts came in at 1.425 million. The forecast was 1.41 million. But again, it is a step back of about 4 or 5% on a month-over-month basis. Existing home sales came in at 4.43 million. The forecast was 4.38 million. But again, it was down about, I think, 4 or 5% from the previous month. So again, looking at the chart, we've been in a steady slide for both starts and existing home sales for quite a while now. But again, the increase in mortgage rates and or interest rates in general, which has pushed mortgage rates up, not really a big surprise. And the index of leading economic indicators came in at a negative 0.8. The forecast was only for a negative 0.4. Last month's number was a negative 0.5. So it looks like that is slipping a little bit. Again, not great news, but anyone who's been paying attention, not really too surprising. So, all righty. Well, let's go ahead and read through today's market recap real quick. S&P 500 struggles for direction amid tough Fed speak retail earnings. The S&P 500 inched higher after struggling for direction Friday as investors weighed up further hawkish remarks from Federal Reserve officials and the latest wave of quarterly earnings. Boston Federal Reserve President Susan Collins said, quote, all possible increments, quote, of rate hikes were on the table for the Fed's December meetings, including a 75 basis point rate hike. The comments echoed similar remarks from Fed members who this week have insisted that further monetary policy tightening is needed to quell inflation. I know a lot of people out there, especially the financial journalists, have been just cheered on the Fed slowing down their rate increases. I'm not sure who's bribing these people to be such cheerleaders. I mean, it's been like this for months. As early as when they started the rate increases, they were already talking about when they're going to stop increasing rates. It's like, well, guys, we haven't even fixed the problem that they're raising rates for. Let's solve that first. Let's see here. Treasury yields have continued to strengthen against the backdrop of hawkish remarks from Fed members, pressuring growth sectors of the market like tech and consumer discretionary. Big tech traded mixed, with Alphabet and Microsoft leading the decline, while Apple and Meta traded slightly higher. Amazon, meanwhile, fell 1% as the e-commerce giant confirmed job cuts would continue into next year amid a challenging economy. Chip stocks remained in the red as Applied Materials gave up some gains despite reporting third quarter results that topped analyst estimates. Boy, that stinks when you do better than what the analysts think, and you still give up ground in your stock price. Energy was also a big drag on the broader market as oil prices fell amid ongoing fears about weaker demand in China amid ongoing COVID-19 restrictions. That seems to be a repeat sentence over the last 6 months. I mean, China's always shutting things down. The fall in oil prices is, quote, due to concerns about demand amid rising COVID cases in China, which make it unlikely that coronavirus restrictions will be relaxed anytime soon, end quote, Commerce Bank said in a note. The flurry of earnings from retailers, meanwhile, continued to show mixed performance. Foot Locker raised its full-year guidance after reporting better than expected quarterly results, sending its shares more than 8% higher. The apparel and footwear retailer also said it expects a less challenging environment in Q4 than previously expected, with comps planned down only 6 to 8% versus messaging from management previously that comps will be down double digits, end quote. Wedbush said after lifting its price target on the stock to $37 from $30. Gap reported swung to an unexpected profit in the third quarter, driven by stronger sales momentum as a result of sequential improvements in comps across brands, Goldman Sachs said in a note. Williams and Sonoma, meanwhile, reported quarterly results that topped estimates on the top line, but pulled its guidance Through fiscal 2024, citing macroeconomic uncertainty, its shares fell 7%. In other news, Carvana slumped 6% as the used car retailers is set to cut 1,500 jobs or 8% of its workforce, CNBC reported, citing an internal memo. So, yeah, the jobs cuts, it seems to be a more common headline or part of articles I'm reading here these days. All righty, well, let's go ahead. And next up, U.S. existing home sales plunge. Tight inventory keeps prices rising. U.S. existing home sales tumbled for a record ninth straight month in October as the 30-year fixed rate hit a 20-year high and prices remained elevated, pushing homeownership out of the reach of many Americans. Despite the broad decline in sales reported by the National Association of Realtors on Friday, housing supply remained tight with considerably fewer homes coming on the market than in the prior year. The housing market has been the sector hardest hit by aggressive Federal Reserve interest rate hikes that are aimed at quelling high inflation by dampening demand in the economy. Quote, the combination of rising house prices and mortgage rates have sent housing affordability plummeting, end quote, said Daniel Vielhaber, an economist at Nationwide. Quote, the decline in affordability is by design to some extent. The Fed's goal of slowing economic demand by raising interest rates starts with home sales, end quote. Existing home sales dropped 5.9% to a seasonally adjusted annual rate of 4.43 million units last month. Outside the plunge during the initial phase of COVID-19 pandemic in the spring of 2020, this is the lowest levels since December of 2011. Economists polled by Reuters had forecast home sales would tumble to a rate of 4.38 million units. Housing resales, which account for a big chunk of U.S. home sales, slumped 28.4% on a year-on-year basis in October. And that was the largest drop since February of 2008. Existing home sales dropped sharply in all four regions. Sales also declined across all price points on a year-on-year basis. Even as demand weakens, housing supply remains tight, limiting the slowdown in house price inflation. The median existing house price increased 6.6% from a year earlier to $379,100 in October. That marked 128 straight months of year-over-year house price increases, the longest such streak on record. Though price growth has slowed from June's peak in line with normal trends, the NAR estimated that prices in October were considerably above their pre-pandemic level. The Realtors Group also reported multiple offers continued in some areas, and 24% of homes sold last month were above the asking price, reflecting the still tight inventory environment. On the other hand, homes unsold after more than 120 days saw prices reduced by an average of 15.8%. There were 1.22 million previously owned homes on the market, down 0.8% from both September and a year ago. So it's going to take some time for all that inventory to shake out and for rates to top out. But it will happen at some point, sooner or later. If you're in the market, you may just have to sit on your hands for a little bit and wait for, either the economy to get real sketchy and prices to fall or, just for rates to come back down. All right. Last article I got here, the average retirement age in the U.S. So determining when to retire can be tough. There are various factors to consider, including your financial situation, your health, and your lifestyle you wish to enjoy once you retire. While the decision of when to retire is personal to you, it may help to know when people typically retire. So what's the average retirement age and how's it changing? And what financial considerations should you weigh before you retire? While we answer these questions below, speaking with a financial advisor, blah, blah, blah. Workers in the United States generally retire at around age 64, though data shows that the average age varies by state. For example, the average age of retirement in Washington, D.C. is around 67, while many other states average is around 65, such as Iowa, Kansas, and Maryland, Vermont, and Texas. Other states boast even lower ages like Alabama, Kentucky, and Michigan, 63, or Alaska and West Virginia, age 61. In recent years, the average retirement age has risen. In 1986, the average retirement age for men was about 62, and for women, it was about 57. By 2016, the average retirement age for men had climbed to approximately 65, and for women, approximately 63. Changes in Social Security, fewer employer pensions, and even extended lifespans can cause many to put retirement off at least a few years. Additionally, with the average Social Security benefit at just $1,503 a month and pensions on the decline, hopeful retirees may find that their retirement budget and expected spending far outweigh their expected income. That can cause them to put off retirement. So, all right. And then some of this just goes through the how much you lose when you take retirement early at 62 or Social Security at 62 versus waiting until age 70. because there is a reduction, and then there's an increase from your standard benefit if you wait till age 70. So, or 67, depending upon your age group. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope everyone has a good weekend, and I'll talk to you next time. Bye.